Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Sedan. This week, we're covering the rescheduling of certain marijuana products from Schedule 1 to Schedule 3 and what that means for businesses that sell those products. Spidell's Summer Tax Update brings together the topics our customers consistently ask for so you get the information that's most relevant to your practice. For this year's topics and to register, go to spidell.com and click Webinars. The U.S. Department of Justice issued an order on April 22, 2026, immediately rescheduling FDA-approved marijuana products and state-licensed medical marijuana from Schedule 1 to Schedule 3, which means that the IRC Section 280 Cap E limitations on cannabis businesses no longer apply to expenses associated with such products, and taxpayers who purchase cannabis products for medical use may now be able to claim a medical expense deduction. The order specifically reclassifies from Schedule 1 to Schedule 3 marijuana, marijuana extracts, and Delta-9 THC and other compounds derived from the marijuana plant, other than the mature stalks and seeds, that fall outside the definition of hemp, but only if they are included in an FDA-approved drug product or subject to a state-issued license to manufacture, distribute, and/or dispense marijuana or products containing marijuana for medical purposes. It's important to note that the order does not legalize recreational use at the federal level, override state laws, or end all restrictions. The order also does not reclassify recreational cannabis as a Schedule 3 drug, which means the IRC Section 280 Cap E limitations still apply to expenses related to selling recreational marijuana, and purchases of marijuana without a doctor's prescription do not qualify for medical expense deductions. However, the DOJ is expediting the ongoing rulemaking process to fully remove marijuana from Schedule 1 and place it into Schedule 3. Under Section 280 Cap E, businesses trafficking in Schedule 1 or Schedule 2 drugs under the Controlled Substances Act cannot claim any business-related deductions or credits except cost of goods sold. The Treasury Department will issue additional guidance to clarify how cannabis businesses selling both recreational marijuana and medical marijuana can apportion their deductible expenses between their two lines of businesses. On their FAQs page for the cannabis industry, the IRS clarifies that IRC Section 280 Cap E does not apply to businesses legally growing and selling hemp that contains 0.3% or less of THC. In order to claim a medical expense itemized deduction for purchases of state-approved medical marijuana, the taxpayer has to pay for the cannabis during the tax year and not be reimbursed by insurance. The taxpayer has to have a prescription from a licensed physician, and total medical expenses need to exceed 7.5% of the taxpayer's AGI. In states that currently allow medical marijuana, the marijuana can be obtained if a doctor makes a recommendation for the patient to use marijuana rather than a prescription. This is because doctors are prohibited from prescribing a Schedule 1 drug. We'll have to await further IRS guidance to see if these physician recommendations will qualify the taxpayer for the medical expense deduction or whether these taxpayers will need a prescription. Despite reclassification as a Schedule 3 drug, cannabis remains illegal at the federal level without separate legislation, so it's unlikely that the reclassification will open up more banking opportunities to cannabis businesses. We covered this topic in a recent issue of Spidell's Federal Tax Letter, a monthly newsletter plus a searchable online archive of back issues that keeps you at the leading edge of the federal tax issues that impact your clients. You can get details and subscribe at spidell.com under Publications. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.